On January 1, 2022, Junski Company acquired a 10% interest in an investee for 3 million pesos. So the investment was accounted for initially at fair value through OCI. The fair value of the investment was 3.5 and 4.5 on December 31, 2023. All right. So if we will compute for the journal entries and record the journal entries for 2022, on January 1, 2022, we would debit financial asset at fair value OCI and credit cash. All right. On December 31, 2022, the fair value of our investment increased to 3.5 million. So there would be an unrealized gain OCI, financial asset at FVOCI, credit unrealized gain OCI. That would be fair value of 3.5 million minus our 3 million carrying amount. 500,000. What else? In 2022, the investee reported net income of 4 million. However, since we are accounting for our investment under the equity method, we will not recognize a share in our investee income, right? That's based on our equity theories. Now, the next line would be the dividend. We paid dividends of 5 million on December 31, 2023. Therefore, we received it partially. Take note that this is the total dividend paid. So there's a need for us to compute the percentage of dividend that we receive. So debit cash, since this is a fair value method, we credit dividend income. That is 5 million multiplied by we own, based on the first line, 10%. So that's 500,000. That's just a coincidence on our first entry there, recognizing the unrealized gain. Alrighty. So no entry on the share of net income under the fair value method. In December 31, oh, that's for 2022, right? So let's just transfer it here. That's 2023. So aside from that, if there are no entries in 2022 anymore, let's just put it there and just change the date. On December 31, 2023, we will again account for the change in fair value. This time, the fair value of our investment is 4.5 million. So once again, there is an unrealized gain which will be recognized in OCI. Our fair value in 2023 is 4.5 million. Last year, our fair value, our carrying amount in 2022 is its fair value, which is 3.5 million. All right. So that is 1 million unrealized gain. That's a lot. Okay. So we did not receive any dividend in 2022. Again, since this is still accounted for under fair value method, we don't recognize any share in the net income of our investee. In 2024, however, in 2024, the entity acquired a further 15% interest in the investee for 6.750 million. So we would debit investment in associate and credit cash for the additional 6,750,000. In fact, we can first recognize it as financial asset at FVOCI. That's okay, as long as we know to complete these entries on January 1. Now that we classified our investment as investment in associate, because now our ownership is not just 10%. With the additional 15%, our ownership is now 25%. So let's account for that. Ownership, now 25%. We will account for this as equity method. Okay? So we will now reclassify our financial asset balance to become our investment in associate. So debit investment in associate, transfer everything from the FVOCI to that new account. What is the carrying amount of our financial asset at FVOCI on acquisition, additional acquisition date? That would be our carrying amount in 2023, which is the fair value, 3.5 million, plus the cost of our additional acquisition, 6.75 million. So that's 10,250,000. After moving our account title from financial asset FVOCI to investment in associate, we also close, that is very important to remember, close our unrealized gain OCI account. And when we are closing unrealized gain OCI account, because we have acquired additional investment, it will be closed to retained earnings. So debit unrealized gain OCI and credit retained earnings. So what's our balance of our unrealized gain OCI? In 2022, we have an unrealized gain of 500,000. In 2023, we had another unrealized gain of 1 million. So our total unrealized gain is 1.5 million. Take note that we won't do this if our investment initially was accounted for under FVPL, because under FVPL, there would be no accumulated balance, right? So let's also put it here. If investment is FVPL, no need for this entry, since there's no accumulated balance. Okay. 1,500,000, 1,500,000. So moving forward, we are now accounting for our investment under investment in associate. So what else happened in our cost? Our cost of investment is now our original 10% carrying amount. The last carrying amount of that is the fair value in 2023, which is 4.5 or 3.5 million. Hold on. Oh, please change our answer here. It should be 4.5 million. That's our fair value in 2023, right? 4.5 million up here. Okay. So minor revision there. Nevertheless, 4.5 million, that's our fair value in 2023. That's our carrying amount, right? Now, for the 15% additional, we have acquired it for 6,750,000. So our total cost is 11,250,000. The carrying amount of net assets acquired is, let's see, 36 million. Remember, we didn't acquire the entire 36 million. We only acquired a total percentage of 25%. That's from the 10% original ownership that we had and the 15% additional ownership that we acquired. Okay, so there is an excess of cost, 2,250,000. How do we account for it? That is either through the fair value undervaluation or goodwill. Let's see. The fair value of the net assets invested is equal to the carrying amount except for an equipment whose fair value exceeds carrying amount by 4 million. Okay, so 4 million multiplied by, we own a total of 25%. So the undervaluation of equipment is 1 million. So therefore, if our total excess is 2,250,000, 1 million is coming from the undervaluation of equipment, nothing else is given. The remaining 1,250,000 represents the goodwill. This is given because we believe as the investor in the potential of the company to grow. All right? Hence the term goodwill. So in the year end, we will now account for the investor share in the investing net income. Take note that in the past 2 years, we didn't care about this because we are using the fair value method. This year, because we are now investment in associate, we have a debit for investment in associate and credit investment income. That is 8 million income multiplied by 25% ownership. That's 2 million, 2 million. Next up, we received dividend in 2024. Same amount as 2023. This time, since we are now accounting for our investment as investment in associate, we will treat this as a return of capital. So debit cash, credit, investment in associate. So the total amount is 5 million. We have received 25%. Notice how it's different from last year? So that would be 5 million times 25%. Alrighty. Okay. And don't forget, since we have an undervaluation, we need to account for its amortization. So undervaluation, amortization, which is the equipment. So the undervaluation is 1 million. Since this is equipment, we will, based on our notes, we will amortize it based on the equipment's useful life. That would be 5 years. You see that in the second paragraph, third paragraph, row 7, remaining life of 5 years. So that would be a debit. Since this is amortization of undervaluation, this would reduce our investment income and also reduce our investment in associate. All right, so 1 million divided by 5. 1 million divided by 5. 200,000, 200,000. So if the problem asks us, how much is the investment income in 2024? That would be our share in net income of the investee, which is 2 million, but it is partially reduced by the undervaluation amortization. Right? We debited investment income here. So the investment income in 2024 would be 1.8 million. How about its investment in associates? So let's use our T account here. What would be the balance of our investment in associate on 12/31/2024? So our beginning balance is the total cost of 11,250,000. The investee's share in net income is 2 million. The overvaluation amortization is 0, right? So our total here on the left side would be 13,250,000. Therefore, the total here on the right side should be the same, right? The dividend received is 1,250,000 and the undervaluation amortization is 200,000. Therefore, if the total of this column is also 13,250,000, the ending balance should be 11,800,000.